You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good to be with you, Jim. Another lovely weather here in Vancouver, and not so good weather these days in the financial market.
What's shaking down there?
There's been great speculation focused in China and Hong Kong. There's a whole bunch of new stock traders coming into the market. What was the number? 1.5 million new eager stock speculators getting in, many new issues being done, and then also with that many new clients coming into the brokerage business, you got to be expanding the number of brokers as well, and they may be inexperienced too. So, and also, Jim, we're in the seasonal period where you can have tremendous flare-ups in the financial market. So let's just look at it. For how many centuries you've had a tendency to have a low in the fall and a high around May. So we'll look back on the S&P here, where into October it gave, on our model, a technical reading, it gave called a springboard buy, which is a pattern that comes in on a rising stock market. So that was a fair drop-off. I think it was about 9% on the S&P, so it turned out to be a healthy correction. And then you go out and you figure, okay, sometime around April or May, you could have a high. But what we're getting in some of the very speculative markets is sensational highs. And then if you look at the senior markets in New York, whereby you have been running at lofty momentum and lofty sentiment figures, well, since late last summer. It's backed off a few times, but this is a very impressive top that's building. So you have speculative moves in the New York market and incredibly speculative moves in China and Hong Kong. To relate, great bull markets are global events, and they expire globally. The same as great bear market conclusions, they're global events, and they expire globally as well. So the stock market now, seasonality, it can continue for a few weeks yet. We looked at the momentum earlier today on the FXI, which is the Shanghai ETF, and it's up there at good momentum figures, but if you look at what was going on in 2007, it could stay up at high momentum for a while yet. So what we'll do over the weekend is look at some lines in the sand type of numbers and just see what we can do here by watching for the kind of reversal that would say the bull market is concluded, and but that'll take some work. On the credit markets, now that's the stock side. On the credit markets, there's a lot going on. You had the change a year ago in June to a widening of credit spreads in the U.S. Corporate market, where corporate spreads yields were widening relative to treasuries, and that, of course, was tied up with the hit in crude oil prices, and as we'd worked on, the plunge in crude could end in December or January. It ended in January. Then that was really pushing down the price of junk bonds and widening the spread. So that sort of exhausted itself, and we've had a recovery in both. And on the crude oil and other commodities, we're looking for what we called a rotation, where traders would get into some of the depressed sectors, which had been lately commodities, certainly with the crude oil. So we've had some happiness in that department. There's been some recovery in some commodities, and there's been some recovery in the junk bond prices and some narrowing of spreads. So these are the widely traded spreads that people can follow, and this is also seasonal. Maybe this is what helps the seasonal in the stock market, is in the credit markets, where you can have narrowing into April or May, which we've got. And then, but underneath it, there's something very interesting going on. Could be called startling. And economic numbers that they follow, like employment figures, well, they're kind of phony. But there's inventories, sales to inventories, industrial production, and these were looking pretty good till about Christmas, and then all of a sudden a number of them weakened, and they weakened sort of surprising the community, all the economists that follow those numbers very closely. And you now have, I think, three months in a row now with U.S. industrial production down. And similarly in China, there's some numbers are getting softer. But inside it, there's one that came out in early April, and it sort of got brought to the forefront the previous week. And that was a report from the Credit Managers Institute or whatever it is. And they gave summaries of what their activity was. And one was a reduction in loan applications. And then the other was a sharp increase in loan rejections, where people are applying for loans and the lending agents are saying no. So this is a sharper decline in any of these theories than you had in 2007. So it sort of weakened a bit from the high, and then the last two monthly reports, which would be to the end of March, sharp declines. And so that sort of got people's attention. So there's some very serious warning flags out there, and we should respect them because these credit managers are not paying any attention to what the central bankers are trying to do. Of course, the central bankers are trying to keep the bubble going. And we should step back a few years to recall the crash of 2008. And here's where there's a major failing on the economics side, is they have this idea that unless the central bank steps in, selling pressures in the financial markets will go on forever. So then they stepped in and eased the money, and the crash concluded. Most of it was in October of 2008. Then the final in the U.S. was cleaned up in the first quarter, and then away we've gone. So, but they have this idea that unless they're really easing credit, these are the central bankers, that it's never going to get better. But what happens is the market moves on its own pace and its own timing, and this bull market has run longer than we thought it could, but nonetheless it has. But what the central bank ease has done is added more to the speculation that would have occurred anyway. So here you have, you've got yields in the German 10-year note is down to 0.12%, and of course in the U.S. you got T-bill yields at zero. So you mean having a German 10-year note trading at almost zero is really, really strange. But in looking at European bonds this week, the yield on the 10-year note for Greece has moved to new highs, 12.8% or something like that. So it's moving. And if you take a look at pressures in India, the Greek situation, and the credit manager situation in the United States, these are serious warnings. And we should consider them. One should be lightening up, I guess, on the general stock market. Our advice that the commodities would recover, I guess the best move came in the in crude oil. If anybody's playing any commodities or commodity-oriented stocks, it'd be time to take some money off the table on that one.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, what's happening with precious metals right now?
Yeah, the gold has come down and set a double bottom and can recover, but we like to emphasize that positioning in gold is more like a trade. Certainly people should have some gold as a safety thing and a safety deposit box, but to buy gold at, say, $1,200, hoping to sell it at $1,300, that's trading. But for investors at this stage, we're at the bottom of a terrible bear market in gold shares that began in 2011 when it became so hugely overbought. So we like to look at the gold sector as the stocks are for investing in, gold itself is for trading. And the advice in our November study we did on gold was to begin to accumulate some gold stocks on weakness. There's been a couple of opportunities there, and there's been somewhat of a rally. We wouldn't add the positions now, because if credit markets, now here's the trick on this one, is that in credit spreads and junk bonds, there's usually a favorable season, as we said, into May. And when that seasonal favorable is over, then it's going to join the problems in the credit managers' numbers. So after mid-year, there may be greater pressures in the financial markets. So we like the gold sector, but we wouldn't load up on them, and would wait for perhaps an opportunity in the fall. And in the longer term, the real price increase in gold is due to the unique liquidity of gold, whereby investors and careful people then go to U.S. Treasury bills, just a place to park your money with liquidity so you can get out. There's no liquidity in the long U.S. bond. All the years of experimenting by the Federal Reserve has pretty well ruined that. And so the place to be is to have the liquidity of gold. But there, you're not buying gold. Those people are not buying gold to make money on it. It's a place to park your funds in a storm. So where conservative, very big funds can buy gold as a haven, they're not buying it to make money. Just to wrap this up, Jim, we can say that pressures in the financial markets could become very serious after mid-year. This would put some pressures on most equity markets, and also most asset classes can come under pressure too. All asset classes, the ones that have gone up, have been very artificial with all of this incredible bond buying by, for a while, the Federal Reserve, and then now the European Central Bank. And this has been the most radical experiment in policy making, I would say, in history. And there's not going to be any easy way out for them, and it's going to be fascinating to watch this as the next month or so rolls off the calendar. So we're looking forward to seeing what happens, and we're being careful at the same time.
An important reason why people should stay tuned.
Let's do that.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.